Welcome everyone, and thank you for joining us for our our M&A webinar series. We're going to be talking about navigating qualified opportunity zones and the qualified small business stock exemption after the OBBB Act. My name is Anna Derewenda. I'm a partner in our tax section based out of our Richmond Williams Mullen office. I focus my practice on pretty diverse range of both corporate and pass-through companies, helping them mostly with M&A, but also just going through and navigating the tax laws, both on the U.S. side and for companies operating internationally. And I'm joined today by my colleague, Jenny Connors.
Thanks, Anna. Similar to Anna, our practices overlap in many ways. I'm a partner in the tax group here in Richmond and represent businesses and investors with a particular emphasis in flow-through entities and the taxation of those entities. And we're happy to be here with you guys this afternoon.
So before we jump into the topics, we've got a few housekeeping items to go over. At any point during the presentation, you may submit questions by using the Q&A button at the bottom of your screen. Time permitting, we will address the questions at the end of the presentation. If you're having any audio or technical problems, please use that same Q&A button and our awesome team will work to get those resolved. And finally, you will receive a copy of the presentation materials and a link to the recording by email after the program. So no need to write everything down. Some of that will be in the PowerPoint. So I think we can get into the next slide and start in. So I think next slide. So one of the major changes in the One Big Beautiful Bill Act was changes to Section 1202. So that provision has been in the code for a good bit of time, I think since 1993. And this act allows taxpayers to, I think, take further advantage of that section. There's some increased benefits there. So we'll go through these in more detail, but the highlights are we've got an increased gross asset threshold. We have higher exclusion caps. We have some inflation adjustments that can be applied to those, and then also some staggered holding period exclusions. So if we go to the next slide, we can kind of put those in context. So under the prior law, we had some very strict requirements for QSBS, or Qualified Small Business Stock, under 1202. And I feel like this is one of those sections that is now turning into, it seems like a pretty, the rules on their surface seem pretty easy, but then once you start peeling back the layers and start really reading some of the nuances, it gets pretty complicated pretty quickly. And I think that is helped or not helped by the fact that there hasn't been a ton of guidance on 1202. So it sort of leads to practitioners and advisors really going through those rules in very, minute detail, because there are certain sections that are, reference, for example, like some holding periods, but those other sections don't reference those, or there's tacking for holding periods on some pieces, but not others. There's references to certain reorgs, but not other reorgs. So I feel like, we'll set the stage of where we were, but just to say that, I think we're seeing one of these sections really in its evolution, that although the section is going to have some great benefits, I think that can be taken advantage of, we're also going to have to pay really careful attention to some of these changes and some of these nuances that I think are going to make following this section pretty complicated. But we'll start kind of where we were before the OBBB Act. When we were going through these requirements, we always wanted to make sure that because it's a pretty big exemption that you can get, we wanted to make sure that we really met all of these requirements. So we have to have original issuance from stock that is issued directly from a domestic C corporation. That C corporation can't be a RIC or a REIT. You have to meet the gross asset test. So that corporation's gross assets, and that is based on the amount of cash and the aggregate tax basis. So not necessarily fair market value, but that could not exceed 50 million before or immediately after the stock issuance. The company has to be engaged in an active U.S. trade or business during substantially all a shareholder's holding period. And that active trade or business specifically excludes certain industries, like our industry, law or accounting. It also excludes health, finance, and hospitality. So you had to be very careful if you have industries that are, close to those or maybe ancillary, make that analysis of whether or not you qualify. Next slide, please. And then the taxpayer had to have held the stock for more than 5 years to qualify for the exclusion. And it was limited to the greater of 10 million or 10 times the taxpayer's basis in the stock. And so and this is limited to non-corporate taxpayers, so individuals or trusts, if they met, and if the company met these requirements, then they were able to exclude some portion of their gain on the sale of this stock. And so I have here that these rules are applicable for stock acquired, are still applicable for stock acquired after September 27th, 2010 and on or before July 4th, 2025, because that's when we have the 100% exclusion. Going back to 1993, for one period of time, there was a 50% exclusion, and then there's also a period of time where we had a 75% exclusion. But most recently, we've been seeing this 100% exclusion. So all of these rules are still applicable to previously issued and acquired stock. And if we can go to the next slide. So what did the OBBB Act change? It didn't change the original issuance, so we still need a domestic C corporation. It did change the gross asset test, so there's a little bit more flexibility in that now. So it changed that from 50 million up to 75 million, and that is applicable to QSBS that's issued after July 4th. And another benefit is that that's actually going to be indexed annually now. So I think that's maybe it's not going to make up for all of the years that we didn't have indexed inflation, but it will be a benefit going forward. And then the next slide, please. The qualified trader business, that has not changed. You still need to have, the company still needs to be engaged in an active U.S. trader business for substantially all of its shareholders' holding period. The holding period, though, has changed, and now we have this sort of phased in, staggered approach. So for stock that's acquired after July 4th, 2025, if you hold the stock for at least 3 years, the taxpayer can be eligible for a 50% gain exclusion. If it's 4 years, they could be eligible for a 75% gain exclusion. And then 5 years is, again, back to that 100% gain exclusion. So I think that's takes a little bit of the pressure off. I know we always get questions from shareholders that maybe haven't met the 5 years. If there's some techniques they can do to, basically sell their company now, but not actually trigger the gain until their 5-year holding period has been met. And that's really not been practical. So having this 3, 4, 5-year holding periods, staggered, phased in exemption may take some of that pressure off and may allow people to take advantage of this a little bit better. So I think, with this, we're expecting to see a lot more folks be interested in C corporations. So you can't take advantage of 1202 for LLCs and partnerships. You can't take advantage of it for S corporations. It's really C corporations. Although I say that, and you can have S corps or partnerships own a C corporation, and that sort of gets into a whole nother convoluted set of rules. But the basic is the gain that you're excluding has to be gained from the sale of stock of a C corporation. So I think what we're seeing are questions from people about choice of entity. So sort of going back to that, how should I set up my entity? Should be set up as an LLC, or is it worth it to set it up as a C corporation? From the get-go. And then also well, if I'm already in an LLC, is it useful for me to convert into a C corporation to be able to take advantage of this if I'm planning an exit in, 3 to 5 years? And in terms of choice of entity, I think some of those considerations that we've always been through are going to be the same. There may just be more, expecting maybe more emphasis and focus on certain areas. So, you'd still be going through, if you operate as a flow-through entity, what is going to be your effective tax rate? Are you still looking at the 37%? Are you looking, maybe to reduce that because you get the 199A exemption? And, versus if you operate in a C corporation, you would be subject to the 21% corporate rate. Plus, if you're making distributions, an additional 23.8% tax to the shareholder on that. So comparing, those two may end up being pretty close. It also depends on, are you expecting to have losses? Are you expecting to make a whole lot of distributions? So comparing those to what would an exit look like and what would, being able to take advantage of this exemption on the gain look like? And would that offset maybe if it ends up being a higher rate under being in a C Corp solution, would that potentially be offset by the exemption? And also taking into account that a buyer may then, if you are in a C Corp, well, then, is it possible that they may end up wanting to maybe discount purchase price because they're not going to get a step up in the basis when they're buying shares from you versus when they're maybe able to do some version of a deemed asset sale if you have it in a partnership or S Corp solution. So sort of thinking through those in terms of that initial choice of entity is something that, we're seeing a little bit more pressure on and people think through. And then in terms of converting, let's say you've already set up your LLC and you're thinking about converting into a C corporation, there's a whole lot of considerations to go through. One is sort of looking at 1202 and can you convert that company in a way that meets the 1202 requirements. So your original issuance requirement often comes up in these discussions, but then also just under the regular like non-1202 rules, what does our partnership look like now? Do we have negative capital accounts? Do we have liabilities in excess of basis that all may get triggered? So typically you can convert an LLC partnership into a C corporation under the Section 351 rules, and can do that tax-free, subject to some of these traps. If you have excess debt, if you have negative capital accounts that could get triggered. So that's something to go through and be aware of. And also, what does that partnership look like? Do you have profits interest that would need to be valued and converted into C Corp interests, or is it possible that profits interest people might actually lose some of their value and status in that conversion? I think the other thing that I'm seeing that's sort of like a hyper technical rule is just because you convert after July 4th doesn't necessarily mean that your acquisition date in that C corporation stock, so being able to take advantage of some of these new rules, would be after July 4th. There is a question on holding periods and whether those would, or acquisition dates, and whether sort of your holding for your LLC interests or the LLC assets would actually cause you to be treated as acquiring that stock prior to July 4th. And I think people are working that through. There's probably a technical correction that needs to happen in the new language in 1202. So I think that's something that we're also working through, and it's just something to watch out for, because if you're trying to take advantage of the increased 15 million limitation, or the increased $75 million gross assets, just being aware that those might not necessarily be applicable on a conversion, I think is important. And it does also depend on, that's also when you sort of get into some of the technical rules of how you're going to make that conversion happen. So that, again, you're going back and making sure that you're fitting within 1202. So are you doing a check the box election? Are you doing a state law conversion? Are you actually moving assets into another company? And whether you're starting with a partnership or an S corp, you may be in two completely different scenarios of how to do that. So in terms of converting from either an LLC or an S corp into a C corp, I don't think it's going to be as simple as, maybe people are hoping for that. Okay, let's just, we think we can take advantage of this. Let's go ahead and do the conversion. I think there's going to be a little bit more thought. And this is where I think some of the convoluted nature and some of the nuances in the rules are, I think, going to come to light a little bit more. So yeah, I think that's just to say for advisors and advisees on the phone, just some things to work through, because you want to make sure you get that right, because it's a pretty big benefit to either gain or lose. So I think those are sort of the big things that we're kind of thinking through and talking about. Oh, the other thing I will also point out is don't forget about the state level side as you're going into this planning and trying to figure out whether a C Corp is right for you because of this 1202 benefit. So depending on what state you're in, not every state actually follows the federal treatment of 1202. I think California has like a specific exemption. There are a few other states that do. So I'm a federal tax person. I always forget about state stuff, but don't forget about state stuff. There may be a difference there that may sort of or add to the analysis that you're going through. But yeah, I think that's, there's a whole lot of directions that we could take this discussion, but in terms of sort of a summary overview of what we're seeing as far as the new rules and, things that we're considering, I think that's been it. But I think, this analysis is definitely, as people focus more on this, I think is going to continue to grow and evolve. And we might even see the IRS actually start issuing more guidance in this area as people want to take advantage of this. So stay tuned. And I think, Jenny, that brings us to the opportunity zones.
Awesome. Thanks, Anna. So for those of you who saw any of my presentations back in 2018, probably end of 2017, 2018, this probably feels like deja vu all over again, to quote the great Yogi Berra. But there are some significant changes to the Qualified Opportunity Zone program. Some of them are really beneficial. Others can be a little bit onerous, but we will first start off talking about some of the highlights. So probably the biggest news on the OZ front is that the program is now permanent. So for those of you, again, who kind of attended my road shows earlier several years ago, I talked all about these timelines. It sort of felt like we had this ticking clock that everyone needed to take advantage of this as soon as possible, or at least, to take advantage of those basis increases. And then the program terminated December 31st, 2026. Now under the OBBB Act, the program is now permanent. So that's good news. One not so great aspect of this new program, or the Opportunity Zones 2.0, is that there are going to be more restrictive requirements for designating census tracts as qualified opportunity zones. The flip side of that is that there are some enhanced benefits for rural qualified opportunity zones. So there may be some additional opportunities for tax savings if projects are based in rural communities. One of the things that's a little bit frustrating about the changes is that the new benefits and timelines for, let's say, OZs 2.0 go into effect after January 1st, 2027. So we have some time. So I think Anna's topic of qualified small business stock is probably a lot more relevant now than, say, the QOZs, but it's still something we should be talking about and planning for, because that will be here before we know it. Finally, one thing that's going to be really onerous for current OZ participants and those going forward is that there's a slew of new reporting requirements that go into effect immediately. So as of the passage of the OBBB Act, July 4th of this year. So that is the one piece of this new legislation that is effective immediately and will impact current OZs, QOFs, investors, everyone who is currently in the program. So turning now to the first topic, the permanency of the QOZ benefits. So the way that these are going to work going forward is that there is a new 5-year gain deferral for investments made after December 31st, 2026. So instead of having this set date like we did under the prior law I guess still currently under the law for those who are in the program right now, as opposed to having this set date of December 31st, 2026, where there's no extension depending on when you invest. So you could invest today and your gain deferral period still ends December 31st, 2026. Going forward, there's going to be this rolling 5-year gain deferral period so that you actually truly get the benefit of gain deferral depending on when you invest. And then another benefit of this sort of permanency in this rolling OZ program is that if you hold that OZ investment, your investment in the QOF, for that 5-year deferral period, you get a 10% basis step up on that deferred gain. So again, looking back in time, prior presentations, I probably talked about the importance of investing either by December 31st, 2019 or December 31st, 2021 to take advantage of that 5% basis step up and then the 10% basis step up. This is going to be a little different. It's going to roll with you. So you are going to get the benefit of that basis step up and the gain deferral for a period of 5 years, provided that you continuously hold your QOF investment. Another aspect of sort of this rolling nature of QOZs is that you get an automatic basis step up to fair market value if you have held your qualified opportunity fund investment for a 10-year period and you sell or exchange that interest or your qualified opportunity zone business or its property. But so long as you hit that 10-year hold and you have a sale or exchange, then you will get the basis step up automatically to fair market value. Alternatively, if you don't sell or exchange your QOF, QOZB, or QOZBP within that 10-year period or between 10 and 30 years, you get an automatic basis step up to fair market value once you've reached a 30-year hold. So for those of you right now who are in the program, there is sort of this drop dead date of December 31st, 2048, where I think you have to sell or exchange your interest to get the benefit of that basis step up. I think the idea of this automatic 30-year basis step up is so that it doesn't force you to sell or exchange property. So again, very beneficial. And once again, just to reiterate, if you are currently in the program, these changes with respect to the timeline, the basis step up, the holding periods, they do not apply to you. They only apply to investments made on or after January 1st, 2027. So next up is talking about some of the OZ designation process, and we can go to the next slide. So the nomination process for new OZs is going to begin July of next year. So this is why I say it's relevant to start thinking about OZs, even though the changes don't go into effect for some time now. And that's because if there is a zone that will qualify as a low-income community, you probably want to start lobbying that it be nominated by the state governor as a qualified opportunity zone. So if you'll recall, the governor is in charge of making those nominations. They nominate 25% of the eligible low-income communities within their state, and then Treasury designates those low-income communities as qualified opportunity zones. New designations will be made every 10 years, beginning with January 1st, 2027. So that designation process will happen every 10 years, clocked off of the year before in July. So it's going to be really important to start thinking through that. The downside is that there is a more restrictive designation process. So there are changes to the low-income community definition. They are more restrictive than the last time. In addition, there are no more contiguous tracts. So previously, you could have a designated zone that was right next to a low-income community, even though it itself was not. That's been eliminated. And also, Puerto Rico had a benefit where all of their census tracts were eligible to be deemed low-income communities, and that was following Hurricane Irma back in 2017. And that has been changed back to the same 25% LIC designation process that applies to all the states. Next slide. So the good news about lobbying your governor and starting to think about this now is there are some enhanced benefits for what are designated or what are referred to as rural areas. Rural areas are cities or towns with 50,000 inhabitants or less, and they cannot be next to an urbanized area that has 50,000 or more inhabitants. So it's worth looking at a map. I'm sure within time, CDFI or some other federal organization is probably going to come up with one of the really helpful maps of areas that could be designated and nominated as QOZs. So stay tuned for those maps, but it may be worth lobbying for some rural QOZs to your governor if you think you could have a project that would fit within a rural community. And the reasons for that are on the deferred gain. Whereas most investors who are not in rural communities get a 10% basis step up on that deferred gain, investors in rural qualified opportunity funds get a 30% basis step up on that deferred gain. So assuming a 20% cap gains rate, it takes cap gains down to about 14%. So that can be really helpful. It also reduces the substantial improvement threshold from 100% of acquisition costs to 50%. Again, if you're dealing with raw land, this isn't helpful, but if you're improving existing property, that can be helpful. Next slide. So, the benefits for rural QOZs are a positive. It's harder to get designated as a low-income community, but at least you do have some of these enhanced benefits for rural QOZs. I think one of the other really challenging parts of the new legislation that's going to be very onerous for current participants are these new reporting requirements. I've included a list of the things that are going to have to be reported, but I think the big highlight of this is qualified opportunity zone businesses, so subsidiary entities that are owned by a QOF, are going to have to automatically and immediately start providing annual reports to the QOFs, and the information in those reports to the QOFs will be filed with the IRS. So for a lot of our clients, we included that in the QOZB operating agreement, that the QOZB had to provide that information to the QOF. It probably wasn't as structured and stringent as now the new legislation is going to make it. But again, that reporting is going to start this year. It's going to be required, and there are steep penalties for non-compliance. So just keep in mind, if you are a current OZ participant, these are the things that are going to start applying effective immediately this year. So I think that concludes today's presentation. And I'm not sure that we have time for questions, but if you have a question that we didn't get to today, or if you have any further questions, you can always send us an email and we will be sure to follow up after this presentation with you directly. Thank you for attending today's program, and please have a great day.